Hey everybody, it's that time of the week you've been waiting for, and particularly this week after the stunning Brexit response. And probably even more stunning than Brexit is this disclaimer. So be astounded as you read through it and study it and understand it. But listen, let's get right into what happened here. Unbelievable. Frankly, I was positioned beautifully, but didn't call for it. I thought that they would remain. Nonetheless, didn't lose any money this week, or didn't lose any money on Friday, so pretty awesome. So look, here's the situation. And all you fully paid up members, of course, you'll see all the trades we did and everything, the hedges, etc. in that section. But for freebies and everybody else, let's take a look here at the S&P 500. Last week we talked about that we were going up to the top end of the trading range, and then I said we would go back down to the bottom end of the range. I didn't think it would happen all in one day. We noticed that we closed near the low of the day. We closed near the low on heavy volume. Of course, we should expect the market to continue lower on Monday and follow through. That would cause us to have the rectangle formation break, and that would suggest a move down to, let's say, 1920. 1920 would be the move. So, that's a couple 3%. Now, let's see, what would it be? It'd be 100 point, about 5% down. So another 5%. We've dropped about 5% from the highs of the move. We'll drop another 5%. That'll give us what's called an official correction, which is a 10% decline. And then I just don't see this turning into a bear market at all. None of the conditions are here for a bear market. What's going to happen is that people on Monday are going to wake up and say, wait a second, what does Brexit really mean? And by the way, when is it actually occurring? Because right now, the betting is that it'll take a full 2 years of negotiation before they exit, and the terms of the exit have not been decided. So there's a lot of potential here, a lot of uncertainty, which is not good for the market, but at the same time, people will go back to worrying about the normal types of things fairly quickly. So this should not be the trigger event for some type of big bear market. Dow Jones, same kind of picture. Here's the NASDAQ. Once again, a similar picture. Our momentum indicators there, on balance volume, the purple line, and also the RSI, that's the green line. They're just confirming the price action, which is obviously bearish. Now, seasonality. Let's take a look at this chart here, because that's it. This is a big change for me. A couple things here. That green line was where I said I was going to flip. And what I said last week is that I was thinking of moving it up to the low we made a week ago. Now, I didn't officially do that, but I'm going to say that's the end of bullish seasonality. We got an extra 7 weeks beyond the normal bullish seasonal period. Normally ends at the end of April, and here we are, 3rd week of June. So I'm looking at this and I'm going, why am I calling it that's the end of it? Well, we didn't break that low. We broke the 1 week ago low, and also we put in a failure top. A failure top is when the market makes a higher low, and then if it's a bull market, we're supposed to make a new high. We didn't make a new high, and instead we gapped lower on heavy volume. Now you can see this is the Russell 2000. It's holding up much better than the other indexes we've looked at so far. But from now on, I no longer want to have extra large positions. I'm going to go into neutral mode right now, and I'm going to just put on regular size positions. However, conservative people should probably move to a half size position because, in fact, you know what? Let me just officially say I'm going to a half size. Why? Because we're going to chop. We're not in a big bull market. This is not going to be an environment where we're going to make easy money. We'll make money. I'm convinced of that. But we're not going to make easy money. So in that kind of environment, we want to kind of pull in our horns. We want to, become a turtle here for a while and put on smaller than normal positions. Smaller than normal. Then I think once the election is over, a lot of uncertainty will be gone and we'll regain our bull footing, and that's when we'll be able to go back to being extra long. But for now, let's go half size. Now, let's take a look at this as well. This is some seasonal patterns from Stock Traders Almanac. Highly recommended that you subscribe. The top line is the incumbent party wins. And so in that case, it would be that the Democrats would win again. And you can see that's a pretty bullish looking picture. Unfortunately, the price action is not following that behavior. In other words, take a look at the price action here in June. We got the little rally, just as we expected, and now we're selling off. The green line shows no sell-off during this seasonal period of time, so I'm going to have to reject that one and say that that one is not a valid seasonal pattern. That doesn't bode well for the Democrats, but nonetheless, that's where I'd have to look at. Now, the blue line is all presidential election years. Once again, we're seeing a sell-off here in late June, and that one really doesn't show a sell-off either. So I'm going to reject that also as what the seasonality is going to be. Now, unfortunately, I just got rid of the two most bullish seasonal patterns. The other three patterns are all showing declines late in June, which is what we're in. The purple line is no sitting president running, which is the situation we have now. Obama has served his 2 terms. He can't run for a 3rd term. I know he'd like to, but he can't. So that one would be the most bullish scenario. We basically just chop sideways with a slight upward bias for the rest of the year. The incumbent party loss, this would be if Trump were to become president, and you can see it's actually, once again, we get a late summer rally, then we get an early fall dip, and then we go sideways. And we end up about where we are now, kind of feeling what it is. That's kind of the way I'm feeling. I'm at this point, I'm not suggesting that Hillary's going to lose and Trump's going to win. It's too early for me to tell that. And then the final one, unfortunately, is the most bearish one, and it would suggest that we would be dropping about 7% from where we are to the end of the year. But right now, it's following that pattern as well. So net, look, it could be up a little, down a little. We're not going to have a bear market. We're already down, like I say, about 5% from the highs. This is saying at the end of the year we'll be down 14%. So that would be something like another 9%. So we'd have a definite bear move here, but not a bear market. Yield curve. Also, we're about to get one of the bullish underpinnings. I've been highlighting this the last couple of weeks. Once again, this is not bearish. But what it means is it's going to be very difficult for the market to rally as we see the yield curve flatten. Asset allocation, I've been talking about this. It did something unusual. We had the head and shoulders formation. It spiked up above and then plunged right back down. So once again, they're moving money out of the stock market. Risk appetite, also, they're running for the hills. Now, if you're a fully paid up member, we've been in utilities, we've been in consumer staples, we've been in those kind of stocks, and they held up great, and many of them moved higher on Friday as people rushed into low-risk type stocks, consumer staples, things like that, boring companies, food companies, people like that. So this has guided us into the correct sectors to be in. Global shares, of course, hammered on heavy volume, and we've been staying away from those for quite some time, although I didn't go short. Bonds, wow, heavy volume. This did exactly what I told you it was going to do last week. Though I told you it was going to stay in a bull market, and I told you it was going to test the 132 level, exactly what it did. Of course, I didn't expect it to spring up quite so strongly, but nonetheless, this is acting exactly as predicted in last week's TradeSmith. Now, one thing is, notice that it opened on the high of the day on Friday and closed in the mid-range. So that's a little bit weak. So look for early weakness in the bond market. Early in the week, I should say. Bond key factors. Our commodity indicators still suggest higher interest rates, but you know what? Nobody's paying any attention. They're focusing on competing 10-year treasuries, and that is the blue line there. So that says lower interest rates still coming up. But first, let's take a little bit of a dip and then rally late in the week. Forget that. I've already told you that story. All right, the dollar. Okay. I was kind of, I kind of said last week, we're at the same price we were back in March, and I didn't really talk too strongly, and I was kind of I went through the slide very quickly. I still want to stay away from the dollar right now. We broke the uptrend line, the pennant formation, and then turned around and broke the high. That still tells me this market is undecided about what Brexit means for the dollar. Obviously, the latest breakout is to the bull side, so if anything, you got to trade from the bull side. But notice it didn't close near the highs. It closed more towards the middle. So if there is going to be a bull market here, and the betting has to be we're going to be in a bull market for the dollar, then it's going to be a weak bull market. And you know what? I don't really like trading weak markets. Gold skyrocketed up on super heavy volume. And as you know, we've been bullish. But to tell the truth, I'm not as bullish this week as I was last week. You can't see it, but gold price closed under that top green line. In other words, it closed just barely above the highs we had made a week before. In other words, it didn't really close strong. It exploded up on safe haven buying after Brexit, and then it weakened. And I think we're going to go back into that trading range, and that gold's not going to be as explosive. It's not going to be that great of a bull market at all. In fact, let's take a look at my next slide. Look at this. 2 out of the 3 indicators I've shifted from bullish to neutral. So once again, that tells us that this gold market is not going to explode to the upside. It's going to be It's going to be I'm long, but not happy. Okay, oil, I've just turned bearish on this. Here we have a big failure top. We broke the trend line, which is no big deal. Trend lines are made to be broken, so that doesn't impress me. But what happened is it broke the trend line, and then we had a throwback up to the broken trend line. And if this was a bull market, we should have made new highs. We didn't. Instead, we made a failure top, and then on Friday, we moved pretty sharply lower. The momentum of the market, as seen by the RSI, is also negative. So I think we're going into a sluggish bear market in oil. All right. Hey, freebies, love having you here. Love having you here. But listen, I'm serious. This is the kind of price action where you need someone with almost 50 years of trading experience to help you out. I'm really being serious here. I don't think you can afford not to subscribe, quite frankly, because this is where you need some guidance. When things are scary like this, when things are wild and crazy, this is when you've got to get some professional advice. And the paid-for version of TradeSmith is going to give that to you every week for a peanut. Really, go to that website up at the very top, sign up. You're going to really, really appreciate it. This next week is going to be pretty wild as well. So check it out. I really think it's a good thing for you. All right. So fully paid up members, hang on. Freebies, we still love having you. Even if you don't subscribe, it's okay. We love having you here. So hang on, paid up members, and we'll talk to you in a couple of seconds.